The major averages are higher today, building on the momentum from their 7-week winning streak. My next guest says, though investors are starting to look at the other parts of the market, it is not time to give up yet on mega cap tech heading into the new year. Let's bring in Tony Pasquariello from Goldman Sachs. Welcome back.
Thanks, Scott.
Head of hedge fund client coverage, of course. So I think the last note said something to the degree of there's still some juice left in this rally. That how you feel?
I think there's a little bit of gas left in that tank. I say that for a couple of reasons. On the fundamental side, I think the interplay between where we've landed on the Fed and growth itself is in a very favorable position. And then you have market technicals. I think flow of funds are still on the side of the bulls. I think basically the seasonals, which have worked like a charm all year, are still on the side of the bulls. Now, we've had a scorching move.
We have.
Since the end of October.
Yeah.
So it is for sure a more demanding setup as it relates to positioning and sentiment and valuation. So I would expect from here, it's more of a grind, less of a gap, probably less upside convexity than what we've enjoyed.
So I'm looking at some of the notes that you gave to our producers where you say U.S. equities are still the best game in town. You ever think at the beginning of the year you'd be writing that today, given what the Fed was doing, where many suggested the economy had to go? You surprised you're writing that today?
If we were sitting here in January, coming off a bruising year for the market, when the kind of consensus call was very much in the hard landing camp, not our call, but the consensus call. And I said, hey, Scott, here's what's going to happen. The Fed's going to blast away 4 more times. They're going to take $800 billion off the balance sheet. We're going to have a regional bank crisis. The geopolitical backdrop's going to get worse and worse, but wait for it.
And in mid-December, I'm going to write that U.S. equities are still the best game in town.
And NASDAQ's up 50+% on the year. That would have felt like very long odds. So how do we get here ex post? What we know is the U.S. economy proved to be much more durable than expected. We'll grow 2.5% this year, create 2.7 million jobs. And then we revealed a couple right tails along the way in the form of AI and the form of GLP-1. And so U.S. economic resilience, American innovation, that was the story that carried the year.
Yeah, props to Hatsias, chief economist over at Goldman. He's been on the right side of the economy trade for a while. David Kostin, in the span of a month, takes his S&P target up next year to 5,100 from 47. Are people getting too bullish? Is there too much euphoria developing over a 6-week run that's one of the most remarkable we've ever seen?
Valuation for me is never a roadmap for how to kind of tactically trade the market. It's not about the next 2 days or the 2 weeks. It is a signpost for forward returns. So here we are, the better part of 20 times. In the past 50 years, we've only sustained a multiple higher than that once, which was the tech bubble. So like I said at the outset, it is a more demanding setup. Now, if Jan Hatsias and David Kostin are right, and they've had a magnificent 2023, the big ball is the Fed's going to start cutting next year 5 times. March, May, June, bang, bang, bang. Then they cut again in September and December. So they cut 5 times. But U.S. GDP growth, again, if we're right, is 2.3% next year. Again, I'd say that interplay between the growth rate itself and the Fed is in a very accommodative place.
Enough to justify that higher valuation that you say?
A little bit. And David, I think, he essentially said, look, it's not 4,700 anymore. It's 5,100. It's not because we've changed our earnings estimates. Not at all. We're just calling earnings plus 5% next year. It's that given what we've learned about the Fed, given the inflation backdrop, real rates can kind of allow for that higher multiple. So for me, it's more about supporting the market and kind of truncating the downside than it is opening up some wild upside tail from this starting point.
Okay, so rotation. In 2 different places for questions. Number 1, we discussed it earlier in the earlier segment. Is money going to come out of cash and go into the stock market? How would you view that?
I think there's plenty of income and cash to go around such that households don't need to hit the bid on the best companies in the world, which are U.S. mega cap tech stocks. So what do I mean by that? 3.7% unemployment rate, continued wage gains, real household disposable income getting better and better as the year goes on. That's your income piece. Then you've got the cash piece, $6 trillion in money market funds. The market showed its hand a little bit last week, $16 billion of outflows, first outflow in 2 months. So I do think a couple chips came forward. And then you've got $150 trillion of net household worth in the U.S. So I think the idea that people can kind of go on the couch and pull out some quarters and dimes and buy short-dated upside in the market, I have no problem with that. I think the idea there's going to be a wholesale exodus from cash is a bridge too far for me.